Hello, everybody, and welcome to the Vancouver Resource Investment Conference channel. My name is Jesse Day. We are bringing the VRIC to you each and every week with our series of expert online panels. And we've got a sequel lined up for you today. We're going to be talking about the energy markets, oil and gas, hydrocarbons, fossil fuels, whatever you want to call it. I think it doesn't get enough coverage, a market I'm very fascinated in personally, and one that I think has a lot of upside potential. And to discuss it, I'm joined by John Polomny of the Actionable Intelligence Alert and Josh Young of Bison Interest. Gentlemen, it's great to have you on the show.
Thanks for having us.
Yeah, absolutely. Thank you.
So this interview got delayed. We were supposed to do it earlier in the week, but Josh, you lost power in Houston, Texas. And as we discussed before hitting record for a full week, now since we are discussing the energy sector, I have to ask, why did this power outage happen? Was it a grid issue? Was it a policy issue? Talk to us about that.
Yeah, it's a great question, and I think the first point is just the fact that there are these sorts of grid failures and power delivery failures is illustrative of the problem with the electrify everything movement. So they're trying to ban gas-powered stoves, they're trying to ban gas-powered air conditioning and heat, trying to move it over towards heat pumps and towards electrified uh, heating systems. They're trying to ban gas-powered cars and move to electric cars. And each of those are very dependent on sort of centralized supplies and centralized controls, whereas natural gas, it is centralized, but it's more analog. And so there's a lot more sort of certainty of supply for natural gas. And then there's certainty of supply for backup power generation, which we, along with many others, will be deploying at our homes. But in terms of the cause, it's a few things. One, bad leadership. So oddly, the CEO of the utility, which is publicly traded here in the sort of Harris County, Houston area, was the CFO of PG&E, which went bankrupt like repeatedly and just absolutely failed to deliver in California. And there's this bad corporate culture in America these days, and probably globally, failing up, where executives are not held to account for their failures and almost immediately, in some cases, get different jobs and promoted instead of punished. And frankly, the CFO for PG&E probably should not have been working again. Forget, becoming the head of a utility of a major area that's relevant for the U.S. economy. So one, I think leadership, right? Like the guy shouldn't have had the job, and then did as you would expect in terms of his performance on the job. They underinvested money, it looks like, that was allocated after Hurricane Harvey, in terms of hardening the infrastructure, hardening the grid. The flood control stuff, it looks like, was fairly well deployed, but the grid and sort of other infrastructure aspects, the reducing flooding in roadways and so on, was not. And so some of that's local political. There's unfortunately a lot of corruption. Houston and Harris County are deep blue, which I think is sort of surprising to folks. They're far left politically, with lots of corruption. The former mayor I think, has had legal issues. The current mayor actually seems okay-ish, which is a nice departure. The county judge, which is actually sort of they run Harris County and is sort of a more powerful political role, has had all kinds of corruption allegations, has been on vacation or something for like a third of the time. And that sort of failure of leadership and sort of very radical socialist agenda and corruption, combined with sort of bad leadership on the public utility aspect. And then you look at just the financials for CenterPoint, and I don't have exposure. I probably should have, right when the power went out, should have bought a bunch of put options on it, because that stock got whacked eventually. But they you can just see in their financials they've been underinvesting in capital expenditures, so maintenance of the grid and also hardening of the grid. It's a Harris County, a major area. Houston's one of the largest cities in the country, very important economically, and they've been taking all the money. It's sort of the old critique of the pipeline companies and railroads and various other things, underinvesting in order to pay larger and larger dividends and larger bonuses to their executives. And it's just a misappropriation. People say, oh, well, aren't you capitalists? Don't you invest in companies for a profit? And yes, but in an area where it's a monopoly that's awarded and enforced by the government, it's very different. There's no competition availability. There's no sort of competitive dynamic. And so without that competition, if it's money that's getting awarded essentially from the public to the private. It's actually sort of more fascism than capitalism. It's not communism because it's a privately held business, but it's sort of in a weird partnership with the government. And there's very many ways for it to go wrong, and there's huge benefits of competition. And so anyway, I guess the easy way to say it, and without sort of the violent aspect, is sort of the economic system that this falls into is fascism, which is sort of notoriously terrible and something that one should be very public, I think, in terms of arguing against and fighting.
Quick break here. This episode is brought to you by West Red Lake Gold Mines. Now, if you know nothing about West Red Lake Gold Mines, let me tell you one thing. This company was founded on the back of a transaction where they purchased the Madsen mine in northwestern Ontario in an area called the Red Lake Gold District, which to date has produced around 30 million ounces of gold from some of the richest gold deposits in the world. Now, what they paid for this mine versus what they got has led legendary mining entrepreneur Frank Giustra to call this transaction the deal of the decade. And Bob Moriarty, founder of 321 Gold, was recently on my show calling West Red Lake Gold Mines one of the two most undervalued gold companies in Canada. If you're curious why these individuals are so excited about West Red Lake Gold Mines, hit the link below to learn more. Now back to the episode.
And in terms of policy failures, well, we're going along that same line. A lot of these different governments, a lot of these political figures, the EU, the head of the EU, Ursula von der Leyen, who I think that's how you pronounce her name. Who cares? She's a parasite. She recently got reappointed to her position. They're all pushing the climate change narrative, and they're all pushing build outs of renewable energy. And it seems that they don't really care what's going to work or not for your average citizen out there, how much they're going to have to pay for electricity, how much grid blackouts like this could happen. It seems like there's a lot of grift in terms of lining the pockets of the people around them and themselves. A lot of subsidies being given to the renewable energy movement. John, you mentioned you think we're at peak ESG right now. How do you feel about the situation at present in Europe and in other parts of the world? Is this house of cards going to come tumbling down at some point in your view?
Well, I think that when I say peak, I mean, it's not going to go away. It's entrenched. Like, this happens, right? When you have this kind of pig trough, feed frenzy going on. And so there's constituencies that have been created. I mean, I started out in this renewable business back when wind was just in its infancy, and I saw how they struggled. And then I saw how the developed, I'm talking about on the political side, the lobbying, the industry organizations. They're just like any other industry now, like the pharmaceutical industry or the defense contractors. They have lobbyists. They do what they need to do. So I don't think it's going to disappear because there's hundreds of billions of dollars involved. But what I do think is what you're seeing is that at least from the perspective of the political movement, yes, they had elections in Europe, and through some finagling, certain entrenched interests were able to stay in power. But you see the trend. And this is something I've always kind of thought would happen is, when people don't give this any thought. I talk about the lesson. It's kind of humorous. I encourage people to go and look at the old jaywalking videos from Jay Leno. Asking, the average person doesn't think about things. You can stand outside of HEB or grocery store, Walmart, and ask people these questions. Where does power come? Where does your electricity come from? They don't know. They don't care. They have no reason to think about it. The only time they think about it is when you have an outage like this or something like that. And to Josh's point, we were talking before we started, people die during these things, okay? It's very hot and humid right now in Texas. You can't live without air conditioning if you're an elderly person. So people actually die. And this wasn't even that big of a storm. I mean, if you have a Katrina type event, so you have a category 4 or 5 and it hits a metro area like Houston, I mean, power will be out for months, okay? And there'll be a big problem. And so I think that I don't think you see anything happen until prices go higher, and then the zeitgeist begins to change. And I think you're starting to see that, but it's now an entrenched industry that has, you know, like a tick, it's got itself ensconced onto the host, and it's not going to disappear entirely. But you can actually see it. You've seen management changes, and some of the big international oil companies. Look at BP, some other Shell. I mean, BP just recently, for example, shut down their offshore wind, basically laid a bunch of people off. So you're seeing this stuff at the margin. That's what I'm talking about when I say peak ESG, because the bottom line's the bottom line. I mean, and the board's sitting there going, okay, well, so they're still going to talk about this. If you look in the annual report, there'll be a sustainability section and what they're doing. But, I don't have a problem with Total, for example, building batteries. They own SAF. They build these lithium batteries, but they're going to have $100 billion in cash flow over the next 4 years. So, these companies are now starting to, I think, refocus on their core competencies, and a lot of it seems like what was fashionable now is now becoming less fashionable because the bottom lines were suffering, and the bottom line always ends up being the bottom line. And one thing I'll finish with is, I have a view that's provocative, which we don't have time to get into today, that a lot of the West and Western Europe and the U.S., unfortunately, to a certain extent, and Canada, Australia, that kind of stuff, is kind of like in a Brezhnev area. It's just kind of floating along, not really with any policies or anything. And so when I look at energy, I'm looking at, okay, what are some serious people doing around the world in the global East and South? And yes, the renewables are built in certain areas, but people are looking at reliability. I mean, you mentioned it. The public utilities have monopolies. This was decided after the Depression. They passed legislation, will give you a monopoly. I mean, you can go look on old images on Google where you see like all these power lines going all over these cities because they had multiple utilities. And so they said, we'll give you a monopoly, but what you will do is keep the lights on 99.9% of the time. And they get guaranteed returns. They just go in front of the Public Utility Commission and negotiate, do we get an 11.5 or 12, whatever they get on their invested capital. And so to Josh's point, but if you don't have utility people, successful people that are good at their business, this is the kind of stuff that you have. So it's a culmination of a lot of things. But I do think when I say peak ESG, it's not going to disappear. I mean, but I think that especially if you see the political changes that might happen, like in the U.S., I mean, you're not going to see the same level of subsidies, but there will be. They'll still keep them, but they won't have. I think, like right now, you have no cap on the IRA, which is basically a Green New Deal. That's why it's such a gold rush mentality. But I think things like that will be dialed back. But I think it's so entrenched now that it's not going to disappear because it's really a lucrative grift.
Now, on the other side of this, does this present an opportunity when it comes to oil and gas? Because that sector is seemingly being left behind in a lot of the conversations about energy. Josh, I'll turn to you on this one. We're at the moment we're seeing WTI under $80 again. However, the XLE ETF is fairly not too far off from all-time highs at this point in time. Is there still value to be had in the oil and gas sector? And if so, which area? Are the big producers still undervalued, or do you have to look further down the chain to find something that maybe looks attractive to you right now?
Yeah, so I think a few things. So just purely from a valuation perspective, there's an almost historic disconnect between large and small oil and gas companies from a valuation perspective. So the small companies are historically cheap, not just on an absolute basis, but also on a relative basis versus large companies. The large companies in many cases are impaired by this sort of DEI nonsense. So I was reading about sort of how this worked. At the start of my career, I was an executive compensation consultant and then a strategy consultant. So I would go into these big companies and sort of help fix them. And from an HR perspective, from a corporate strategy perspective, from a technology perspective. And one of the big problems that the Exxons and Chevrons and BPs, et cetera, have is that the whole competence and sort of promotion for merit system was broken. And so you have big parts of those organizations that are just that were promoted because of, frankly, aspects that would actually potentially be in violation of the law, right? You're not supposed to get promoted based on your skin color or your religion or your sexual orientation. You should be promoted based on being a good engineer or a good HR person or a good manager or whatever. And these organizations are compromised. So I think it's sort of weird that those companies have traded at high valuations despite sort of compromised workforces. And again, not everyone. There's still many really talented people in these organizations, but just they followed the Peter principle to too far of a degree, using sort of DEI and ESG as either an excuse or it was leveraged in a way that allowed people that shouldn't have to get too far. But it's actually sort of weird. One of the things I noticed in the last year or so is that some of the smaller companies started to embrace this sort of ESG stuff. They were so late to the party that some of them are still ramping it up in their own organizations. And I actually see a really interesting activist opportunity here to come into companies that have underperformed. And that, I mean, they sort of just tell you what they're doing, right? Some of these companies, they'll have a 10-page corporate presentation and 3 of the pages will be ESG oriented and their G will be talking about the environment. And it's like, wait, no, there was an E page for that. G is supposed to be about governance and how you're going to like align with your shareholders and do a good job managing the business. And instead it's just about the environment. It's like, guys, or about, social causes, which should be in that S. So I think you're actually seeing things get worse among a set of smaller companies. And so I think there's small companies that are undervalued just sort of as that set of smaller companies. And there's ones that are even cheaper, but maybe even worse from a cultural perspective. And I think that might actually be the single most compelling opportunity in the market because it does involve actually rolling up your sleeves, fighting for control, and then making material changes. The good news is that these changes are not complicated. It's literally just firing people that are doing a bad job and are misallocating capital and promoting people for dumb, potentially illegal reasons, and reorienting companies towards earning high returns on invested capital and returning capital and paying their shareholders.
Yeah, some great thoughts there. It's funny what you mentioned about the ESG and the DEI angle. I remember during the pandemic, I was considering investing in one large Canadian oil and gas producer. I'll leave them unnamed, but that you go to their website and the front page of their website was an very overweight woman in a mask standing on a rainbow, like crosswalk type of image, and their entire homepage was about, we include lesbian and gay people. It was just like so bizarre. And so needless to say, I did not invest in that company, but some very interesting thoughts there. John, where are you currently seeing value in the oil and gas space? I know you also venture into offshore oil field services. You venture into the oil tanker space. Maybe you could talk to us about some of that as well.
Yeah, I mean, even since last time we talked, I still think that there's a lot of potential in offshore services. The things that I've been looking for to kind of show that we're at a peak really haven't started to happen, which would be people building a bunch of new boats or new rigs or whatever. Eventually that will happen because the cash flow, they just can't help themselves. This is what these people do historically. But we haven't seen that. We've seen rates go up for OSVs and PSVs. And, rigs are slowly but surely now being absorbed into the market as we see activity in we have existing basins. Guyana, obviously, Suriname's now starting to be a nice area offshore, West Africa, around Namibia and the Orange Basin. And, everybody knows about these things. So, eventually, I think, you could see we're in the cycle. We're probably in the 3rd or 4th inning of that cycle. There's some still great opportunities. One of the things I'm looking at, if people want to do some work, I mean, you can go to a place like Singapore, and there's probably a good half dozen or so offshore companies that really don't. They're just now starting to get attention, and they might be. I mean, there's one company off the top of my head I'm not going to mention. It's kind of like a mini, Tidewater or something like that. So I think eventually, like I said, these things will generate sufficient day rates and cash flows, which will attract additional capital and then eventually these people will, but I like, this is what I'm looking at. There's still, I've had a really good run. I mean, I'll talk about one company that I really like in Canada that's done really well in the portfolio. It's more of a service company. It's like, CES Solutions. They've really been on a great run. They just basically do a lot of fluids. It's a high margin business. They have operations in Canada. I'm not recommending it. I'm just saying, that's the kind of companies I look for. Do I think there's still value in some of these things? I don't really like onshore as much anymore, but offshore, I still think has a lot of potential. And, like I said, we're kind of after the beginning of the cycle. We're kind of like I said, in the third or fourth inning, in my view. And, I still think there's potential there. But, the problem with this is people want these, like, we're not in the same boat we were when we had the economic crisis and these things were being given away. So you really have to do some work now. I mean, there's quite a few companies that have paid down a lot of debt. They are buying back a lot of shares. So you start looking at, okay, what's your total? It's kind of a total return situation. Okay, what's the free cash flow, long life assets, low decline cash flow, and then how is the management allocating capital? So I still think there's potential there for like some total return type situations, but it's not like a layup anymore like it was a couple of years ago. And so I think that there's still potential to make money there, but again, you have to do work. It's not like where you could just go buy things for pennies on the dollar and all you needed was for oil to get off the floor and go back to $60 a barrel. I mean, my issue now is basically, it looks like oil's probably in a range mid 70s to mid 80s. I heard somebody say the other day, 80's the new 60. I kind of agree with that. We have some economic weakness in Europe and potential recession in the US. China demand's down. I'm not saying that we're going to have like a great financial crisis, but demand and these things are priced, this commodities priced at the margin. So if you have just a regular recession in the US, you could see demand come off a half a million barrels a day or something like that. And if you have a GFC, which I'm not forecasting, you could have over a million, and that's a problem, right? I do think it's interesting. I'm curious what Josh is saying or thinking about this. I just think in the near term, also, at least through the election, I'm noticing that the Saudis and the Russians have cut back on production recently. I'm wondering if there's, they have a preferred candidate, I think. So, seeing an oil price up into the election through the summer up at around 90 or plus dollars a barrel would help their candidate. Let's put it that way, or drill baby drill candidate. So, you can't discount that. And then you can't discount, but I don't buy these things based on these short-term things, or, if the IDF decides to do an incursion into southern Lebanon, and then the Iranians, these are all, they're not zero probabilities, but they're not something I invest on. My major theme stands as always, you have 6 to 7% depletion every year on 102, 103 million barrels a year, plus 1 million to 2 million barrels a year of demand growth. It's been underinvested. The global South and East is growing, and they have almost an insatiable appetite for hydrocarbons. So I think that's really how I look at it. And I think if you look for, like I said, there's companies that can do very well in an environment of oil, in the mid 70s to low 80s on Brent. I think you can find some terrific companies.
And Josh, to follow up, your thoughts on the potential political angle John was speaking about, and maybe if you could give us the data you're currently seeing from OPEC in general and how you think that might influence the oil market moving forward.
Sure. First, it's funny. Actually, one of the recent podcasts I was on was Flowline, which is the CES. They have their own chemicals podcast. So it was sort of odd. 90% of the people they have on are like, the chemicals engineer from like EOG or whatever. And then they had me on. I got to go visit their lab as a part of that, which was fascinating. Their lab in Houston's worth checking out. And to my detriment, I don't own that stock anymore. I owned it for part of the COVID recovery and did really well with it. And then, when the rig count started to fall, I figured, hey, they were going to suffer, and it turned out that they just took market share. It's one of those really interesting things where, there's still significant innovation in oil and gas. There's a ton of technology, a ton of research, and you go to this lab and they're just doing all these different tests, and they have all these different requests from their customers and so on. And there's real innovation going on where they're changing the chemistry of drilling fluid. They're changing the chemistry of production fluid to optimize it, to get more production, to get it cost less to drill wells. And it's really fascinating to sort of see that. And again, any individual one of those things is not necessarily material either to them or to the global oil picture, but incrementally it's sort of, in aggregate, those sorts of things matter. And so I just thought I'd share that since you mentioned the name. But sometimes like knowing too much can hurt you, right? Like it's like the meme where the dumb hey, CES is like good at this stuff, so we'll own the stock, and then the brilliant CES is good at this, so we'll own the stock, and then I'm somewhere in the middle where it's did the work and evaluated the likely rig count change and their sensitivity to that, and got maybe too in the weeds on that one. I think, John, in terms of the economy, I think it is actually very promising for oil. That oil prices are still around $80 WTI. It was 83 this morning. Now it's 80 or 79 something. But still, I think it's promising that oil prices have been this high despite evidence of weakness in multiple geographies. And if you look at it on what the pessimists would look at and say, oh, the world economy is deteriorating, therefore sell. But the optimist, or even maybe the realist, would look at it and say, hey, historically, under most circumstances, when you have this sort of economic weakness and you have this sort of alignment of world governments where they're really trying to have economic growth in exchange for their sort of deal of maintaining power, pushing their social agendas or whatever, in exchange for people having jobs and enough money for food and so on. I think you're actually set up for potentially significant economic growth over time. And so if you can get into these things in a period of economic weakness, at least you have that potential for the recovery. And maybe your sort of base case could be, hey, maybe 80 is the new 60, in which case, if 80 is the new 60 and you should be sort of in a range that's a higher range in order to sustain investment, maybe you have a bias towards much higher prices over time, just from that dynamic and from the potential. And again, it's hard to time these things. No one really knows. People that say they know are just making it up. But which again, you weren't, you're just observing the present, I think, is actually a very important skill too, right? You want to know what's happening. If you don't know what's happening right now, you can't even have a shot, I think, at predicting the future. So I think that's really important. And then Jesse, like you were saying, OPEC Plus has been restricting production. It's an open debate in terms of how much of that is political, how much of that is reflective of their just public commitments to cut to support sort of base price and support the market. How much of it is driven by sort of oil field issues, and in Russia, they've had infrastructure that's been attacked by Ukraine in response to their invasion and continued war there. And so how much of it is infrastructure driven? And Saudi, how much of that is driven by sort of the reduction in their drilling activity and just frankly the maturation? There is this global decline that oil and gas producers face, that maybe 6 or 7%, maybe closer to 10% now that so much of global production is shale, which has sort of an organic decline rate of closer to 40%. I think these are sort of real issues, and actually, I would see my base case is actually not sort of a stable price environment. I had a chat with Arjun Murthy recently, and he sort of is in this more sort of super spiked super volatility mentality where it's like, hey, things may go way higher and way lower. And I do think we're sort of closer to the bottom end of the range, which is sort of a scary thing to say because you're almost immediately proven wrong. You sort of jinx these things by saying that. But I think we're set up for potential significant price spikes where you either see supply fall a little or demand rise a little from here. And if you saw that, I think you could see oil radically higher than that sort of 90 or wherever that people think it's going to spike to. And then if you look at positioning, futures positioning is still actually quite low considering where the oil price is. And so people thought that it was high when it was at these levels a few months ago and last year. But if you look sort of historically where positioning is versus where price is, you could make an argument that you should have twice as many or four times as many futures contracts long on a spec side just to support sort of an $80 WTI price, which again is sort of the market evidence of 80 sort of being the new 60. John, I really like that. I think I'm going to steal it. And I don't know that you came up with it originally, but I'm going to use it. So anyway, I think there's room for, if positioning sort of return to sort of normal levels or normalized, and then you could see prices go way higher, but not necessarily stay there. And I'm not counting on any of that, but I think it's important to sort of be aware that we've been in this range, but that doesn't mean that we're necessarily going to stay in the range. And the fundamentals of the business, as well as the market positioning aspects, both seem to be telling me that we have a shot at lower as well as much higher prices than people are expecting.
You mentioned Russia there and the attacks that occurred against their infrastructure, hampering oil production seemingly, but the Russian Ministry of Finance did release a report that noted the volume of oil and gas revenues from January to June increased by 68.5% compared to the same period in 2023. Revenues also exceeded expectations by 700 billion rubles in the first half of this year. I'd like to get both of your thoughts on, first of all, the lack of effect of sanctions that the West is trying to put on Russian energy. And is this increase in production potentially bearish on the global supply side? John, I'll start with you.
Well, I think with respect to sanctions, I mean, all you have to do is listen to the interview that the Minister of Energy from India gave almost like a year ago, I think, where he says he has 1.4 billion oil consumers in his country, and he's going to buy oil wherever he can get it. And if the price is right, he's going to buy it. And so I think that really, without veering off into all that, but, the global South and East, you're seeing a realignment around the world, okay? This bifurcation, this multipolar world, it's going to happen. It's happening. I think, it's not the only thing that I look at, but it's a major factor of what's happening. And, the sanctions we're doing, I mean, oil's basically fungible for, well, there's different grades, obviously, in different refinery stuff, but, in the end, oil is oil and you can sell it to someone. So, it was inevitable it was going to fail. And, I don't really track Russian production exactly. I do know that their loadings have been down recently. And like Josh mentioned, I don't think, this is a country that has, advanced missile technology and launches rockets continuously from the Baikonur Cosmodrome. And yet everybody in the West thought, well, if Schlumberger and Halliburton leave, then the place is going to collapse. Well, I mean, yeah, these companies are on the leading edge in the West on technology, but, it doesn't really look like it's happening like that. So I think, there's a lot of, views on this. I mean, I've been going to this place, Russia, and these Eastern European countries for 30 years off and on. And I mean, it's not like, some backwards, it's not the perception doesn't meet the reality. So that's, again, another, in my view, this is like one of the things that I focus on. I don't believe in an efficient market because I think people's information that they take in, that they're using to assess different investments, this is just apply to oil, is skewed all the time. And so you have to really look at things for the way they are. And so what's really going on. So in the end, I'm kind of got off track a little bit there, but I don't really have any really particular insight into the Russian petroleum industry as it stands on July 19th. But I do think that one of the things that I am concerned about, that I am more concerned about, is the state of the Saudi oil fields. And I think this is really going to, what's going on with Gawar, what's going on, with this production. And, there is a view out there that I read Matt Simmons's book 20 years ago. I think it was 20 years ago now, Twilight in the Desert. And that didn't really happen. They used to have a website called I think it was called The Oil Drum or something like that. I can't remember. It was all about peak oil, if you will. The world's not going to run out of oil, but, again, the $40 and $50 oils run out. and that's why we're at the, yeah, there it is. And so he made some interesting comments. What's interesting is, I mean, this is a field, this giant field, if you study it and stuff, and people should read Daniel Yergin's book about, the oil industry, the prize. It's very interesting, if you're interested in this stuff. But, it's like, okay, this is not infinite. We see this all the time in Texas. You're driving around and, I've worked on some stripper wells and played around with some stuff like this. This stuff runs out eventually. They go through a cycle. And King Huberts was a geologist at Shell, and I kind of agree with him. So that's why we're offshore Brazil and Namibia and Suriname now, because you find the easy, cheapest stuff first and exploit that. So I don't know. I guess my view is, again, I believe that hydrocarbons, I guess my investment theme is, with all this, just to distill it down, is, I got this 4.5 billion people in this new Fertile Crescent, and they're going to consume oil, and they're going to, it's a spreadsheet exercise. People should just put spreadsheets together. If you just want to get to the Japanese or South Korean level of per capita oil, I mean, oil's got to go to 120, 130, 140 million barrels a day on these demand. Can it do that? I don't know. That's over the next 20, 30 years, but that's where we're heading. And, if you want to extrapolate, demand out. So I don't think we can do that. So I think prices are going to be higher. I agree with Josh. Volatility and all of these things is going to be even more, I think, just because of the new environment we're at in this multipolar world we're entering now. It's going to make things difficult. I mean, they still don't. I was in the U.S. Navy for 15 years. I'll give you an example. Our main mission was keep the sea lanes open. The Red Sea is still not fully open. I mean, the Houthis, this backwards, supposedly they hit Tel Aviv last night from 2,000 miles away. So this is not a joke anymore. People need to take this stuff seriously. And I think that's going to lend itself to more volatility, but that's opportunity. If you have a long-term focus that demand's going to increase and supply is going to be slightly constrained from underinvestment, and you have a situation where you're volatile to the downside, I think that's an opportunity, because I think that eventually, you reset back to that 80, whatever, if 80 is the new 60, whatever. If you get, if we have a recession, or if we have something happens and oil drops to, the low 60s or something like that, I think that's an opportunity, not something to get scared about.
Very well said. And Josh, do you follow the Russian supply side? And if so, what's the situation you see there? And if you could also comment on the situation for Saudi Arabian supply too, that'd be great.
Sure. Yeah. So I think a lot of this is sort of political, less the Russian supply specifically, and more the choice by the U.S. and European and various other governments that had sanctions on Iran, and then made a lot of noise about sanctions against Russia after Russia invaded Ukraine, and then really didn't follow through. And if you just sort of track the export activity by Russia and by Iran over the last 2 years, you can see there's been sort of this political choice to allow these continued exports. And in some cases, it's actually Europe buying, for example, Russian natural gas. They're still buying large quantities of Russian natural gas as a response to maybe they couldn't control this. Of course, they could control it. The U.S. substantially controlled Iranian exports, which is relevant for the comment about the Houthi rocket, which was likely built in Iran and supplied by Iran to the Houthis before it was sent. And it's one of those things, I think, one of the risks, the right tail risks to oil, one of them is, economic growth, which is sort of a weird right tail risk. But if you got back to a global, 3% global growth rate or something, there's just not enough oil. There's just not enough, period. Everything turns on, OPEC turns on. There's not enough, and you have crazy high oil prices. Another right tail risk is that Iran goes one bridge too far. And last night probably wasn't it, but that's the right direction, I think, attacking Israeli civilians. And again, there's sort of this very weird reporting, and people sort of bucket it in these other categories that are inappropriate. It'd be like there was a rocket that fell in New York City that was launched from Yemen, right? How would people respond? Similar sort of concept. So I think there's a risk to Iranian exports, which are not being sanctioned at all, or those sanctions are not being enforced at all by the US, by Europe, by various others. And that could very easily be disrupted And frankly, it would be sort of this weird embarrassment for Europe and the US if Israel went and sunk an Iranian oil tanker, which technically they're not supposed to be sending this oil, but anyone can observe it. Tanker trackers, the other guys, like they show you it's there. You can see it on a satellite. Technically, it doesn't exist according to the Biden administration, according to the EU. So if Israel sunk one of those tankers and the international community got mad at Israel would just say, "Hey, this doesn't exist. What are you talking about? It's a sanctioned cargo." So of course it's not getting shipped because it's sanctioned. So anyway, there is that risk. And that's, very substantial. It wasn't substantial 2 or 3 years ago, but Iran is up to close to 4 million barrels a day of oil exports from, sort of closer to 2 a couple of years ago. So that's been where the oil bulls, I think, me included, have gotten this wrong, is this sort of sustained oil exports from Iran. Russia, it was an outright lie that from a sanctions perspective. Weatherford has maintained full operations as far as I can tell in Russia. Schlumberger has maintained substantial operations in Russia. Halliburton and Baker Hughes did the right thing. It's been very, very weird to me that there's been almost no reporting on this. Some of the energy reporters I used to talk to basically got mad at me talking about this to them so much and just stopped talking to me, which is, again, super weird, right? Like, why would XYZ major news organization care about you? They yell at people for being anti, Ukraine or pro-Russia, but, and people accuse me of that on social media. And yet I'll talk about this and they won't, I don't like Ukrainian corruption, and I don't like US firms or French firms transferring US and French technology over. And respectfully, John, I disagree. I think Russia has some technology that they're excellent at, and others, there's a comparative advantage. There are certain countries and certain companies that are good at certain things. And I think the sustenance of old fields and the application of oil field technology innovations is something that certain of these companies, like CES, is winning market share in drilling, right? They're winning that because they innovate more on chemicals, they do a better job. And so a CES job might actually be 20% cheaper and 10% faster or whatever. And so if you're not using CES, then you're higher cost and less effective. And so across an oil field, if you lose the CES equivalent on Russian services, you could actually have a material negative impact, even if they have technically similar technology and similarly trained people and so on. So I think that's the nuance. It's sort of that incremental change, but they haven't really suffered from it at all. So anyway, I think Russian capacity for the most part, because of these excellent companies still being active there, sort of, weird, almost, it's very anti their own country's interests. So I don't know, there's different words for that, but I'll leave it just broadly characterized. So I think Russian capacity has been sustained by sort of the avoidance of sanctions or the lack of enforcement of sanctions, as well as by disloyal activity by companies that are based in countries that are adverse to Russia, and in some cases supplying weapons and so on to Ukraine. So, and then from a Saudi perspective, we put out research on this, we do think that the Saudi supply base has degraded. It's complicated because when they were producing, let's say, 12 million barrels a day, very briefly, a couple years ago, in response to the Russian invasion of Ukraine, it looked like they had basically no spare capacity, and they were actually eating into their spare capacity to provide that supply. They've now cut back, and so it's sort of hard to tell, is the current supply level their sustainable level? Is 1 million barrels a day higher the current sustainable level? It's sort of hard to tell. They spend a lot of money every year drilling. I don't know that they've spent enough, but I think there's probably a good argument for some spare capacity for Saudi today, but maybe they can't get more than 1 million barrels a day. And if the world thinks they can do 3 million barrels a day more and they can only do 1, then when you get back to sort of a more normalized environment, or, everyone is asking about the election, if Trump comes in and he says, hey, Saudis produce, but I'm going to cut Iranian exports, maybe you actually have higher oil prices, not lower. And maybe Trump doesn't mind that because it's actually good for the US economy. You get more drilling, you get more investment, you get more production in the US. So anyway, I think these things are very complicated, and hopefully I didn't just lose everyone by trying to think through some of those complications.
No, that was a fantastic summary there. I was thinking about this myself not too long ago. What about some of the South American countries? What about Venezuela, for example, which is a basket case and is very left-leaning? A lot of the South American countries, Mexico recently electing a more left-leaning government as well. Venezuela has massive oil reserves on paper, but not the political will nor perhaps the technical ability to drill those reserves in an economic fashion. Is there a possibility of that ever coming to fruition in some way or another? The country changes direction. They get people who want to extract as much oil reserves as possible. And any other South American countries you can think of as well, where that similar situation might occur, where there's a lot of oil that exists under the ground, but no will to extract it. Could that change, and could that be bearish for oil in the future? Josh, I'll go to you first on this one.
So we've actually been waiving sanctions in Venezuela too. There's like no enemy of the U.S. that hasn't benefited substantially in the last few years. I laugh, but it's a horrible tragedy. And frankly, we had a red line, which was that if there was election interference in Venezuela, which of course there was going to be because it's a totalitarian dictatorship, it's not even communist at this point, maybe more fascist than communist in terms of the way that their economy is actually structured and runs. And we subsequently ignored it, waived sanctions, and basically just allowed companies to keep investing. Venezuela's production is down radically from its prior levels, and so it's not that hard. It wasn't that hard for them to bounce from, for the exact numbers, but maybe they were at 2 or 3 million barrels a day, let's say 10 years ago, and 2 million barrels a day a few years ago, and then 1 million barrels a day, and then getting back up from, let's say, 500,000 barrels a day post COVID to 1 million barrels a day is a very different thing than going from like 3, which was sort of their prior peak, to 5 million barrels a day. So I think this sort of recovery from their very low lows, a lot of that was just sort of like patchwork, fixing pipes and fixing pumps and other sort of very basic mechanical work, which really takes very little expertise. And even in a country has an impaired economy and most of the competent engineers and stuff have left. To the benefit of the U.S., right? We've gotten a lot of these great people. Trump recently talked about the criminals coming here, but we've also benefited from some of these enormously talented former, PDVSA employees and various others. And so even without them, they can still sort of get production up a little, which they've done. I don't see this as so potentially negative. Like if Venezuela if they had a Milei that came in and sort of redid their economy and just radically transform them to sort of libertarianism, I actually think that you'd see such an economic boom that even if you saw oil production grow, you might actually see oil consumption grow, at least for that first couple million barrels a day, to offset that potential supply. And again, from an oil bull perspective, that's your ideal situation. It's not oil temporarily suppressed, exports suppressed because of some sort of political situation. It's actually the opposite. Economic growth, even in oil producing countries, is very bullish for the oil price. And it's much more sustainable than oil being held off the market because of sanctions, and then oil supply being off the market because of incompetence of a communist government. So anyway, that's how I see it. And then just in terms of reserves, Venezuela actually, they did have overbooked reserves, let's say 20 years ago, 10 years ago, when they were sort of doing the OPEC dance that, Matt Simmons talked about in Twilight of the Desert, where they just never write down the reserves, they would just add more and more. But when you think about the advancements in Canadian oil sands and in various other places in terms of technical ability to extract original oil in place, Venezuela probably has, they might even have more economic oil there than they have booked. And I know that sounds sort of weird. Saudi Arabia probably has less, and some of the, bonded dentures and stuff for Aramco indicated that, despite their sort of public OPEC statements. Venezuela probably has more, but it's just such a, it's probably a 20-year project involving maybe trillions of dollars of investment, and frankly, very oil intensive to be able to ramp up their production there. So I think it actually may be there. And even with enormous booked reserves, there might actually be even more if you applied SAGD, if you applied various other technologies that at this point are 20 or 30 years old and have been implemented very effectively in places like Canada, but just, they're so far behind, and there's so many challenges in implementing those sorts of technologies there under any sort of current economic framework for Venezuela.
And John, your thoughts, and also maybe you could expand on that and include Africa in the picture. I know we were talking about one particular company operating in Africa before we hit record today. How do you see the future of oil production in that country, in that region, that continent, and your thoughts on the Venezuelan situation as well?
Well, I know about a half dozen former uh, engineers or employees that are here in the U.S. now from Venezuela. They're in totally different jobs now. They'll never go back to Venezuela. Two guys that build houses here in the valley, guy that runs a logistics company in Seabrook. So, uh, you know, this is just a political question, and then just applying sufficient capital, whether it's finance and human capital. So these things can be solved in the right environment. They obviously, Josh hit the nail on the head. They have tremendous reserves there. I mean, it could be one of the wealthiest countries on earth, but the political environment's not going to allow for that right now. I think Josh is right. I mean, I think Chevron went in there and got some permission to do something, and it was just basic blocking and tackling, fixing leaks, putting, whatever stuff that had been stripped away, that kind of stuff. But it would take billions of dollars in years to get, get it going again. What I'm intrigued with actually is like a place like Colombia. I think has some interesting. I think it's really mispriced. And because I think that it's a perfect example of where we have a political situation with a guy that was elected and he was considered he is left wing. But you have to really kind of understand these things. Like they have a legislature there. He doesn't have the ability to just ram through whatever he wants to do. And so you have a company like Ecopetrol. People should, if you're a dividend inclined person, I mean, I think it yields 25%. I mean, so I think it's mispriced just based on some perceptions around the political. I mean, it does have risk. It is Latin America. I mean, I'm not going to sit here and it's not Exxon. But if you look at their like offshore assets, these places are like haven't had a lot of capital, just because of the variances of these political situations or the instability. I mean, you look at like offshore Colombia, I mean, Shell's there, Petrobras. I mean, I think I was looking at a recent presentation. They could have, I saw something like twice the amount of booked oil reserves and 5 or 6 times the gas reserves. So there's potential in these places. You mentioned like Africa. I mean, I'm very interested in Africa. It's 52 countries. There's a difference between like Namibia and Botswana and Rwanda and Equatorial Guinea. So you have to look at them individually. But this Orange Basin, I mean, you don't have to be much of a geologist. You can see that part of Africa used to be connected to South America. If you want to look and you see as it pulled apart, so the geology, I've said, this is a speculative statement. It's not meant to be provocative, but I think that that area has, could be a Guyana type 2.0, but you're not going to see anything happen. I mean, you see these, Venus was the biggest discovery in 2022, I think. Mopane, that Galp just found could have 10 billion barrels. I mean, this thing hasn't even been fully explored yet. So you have like Total's increasing their budget there to $1 billion. But you're not going to see any first production there, or FIDs for first production till, later this decade. So, but I think it has tremendous opportunity. And there are some companies there, but they're mostly going to be the larger companies. There's a couple juniors that have some lottery ticket potential there. I really don't want to get into it, but I think, I think it has tremendous, it's going to be a tremendously high growth area. And it has the potential to, like I said, be a million and a half barrels per day production, but over the next 10 years. It's not going to happen in the next year or two. So, but I think that, it could be like a Guyana type 2.0. And I think there's still a lot of opportunity, like even in some areas in Asia and stuff. So there's still a lot of oil and gas out there, even like in the Gulf of Mexico still. And I think, if you get the right administration in place, I mean, a lot of this is political. Josh is exactly right. The Biden administration has waived everything because the goal is to keep inflation down. That's people's main concern. And the main thing that the average Joe Sixpack sees is the gasoline price. You remember the stickers that they would have, people were putting on the pumps showed Joe Biden pointing at the price as you're on the gas pump and said, I did that. So That's what they're sensitive to. That's why so if you get a Trump administration, do they bring back sanctions on Iran? Do they bring back sanctions on Venezuela? I mean, so there's all these different things going on. But yeah, I think, I'm just fascinated with you could make, if you talk to an economist, they'll say you'll never run out of oil just because of the fact it's not geological certainty, it's just financial certainty. Price would go sufficiently high and you'd find substitution, all this other stuff. So I do think, though, that there's going to be tremendous opportunity, because what I'm fascinated about is two things. What's really going on in the Permian? Can they maintain production? And I thought, you listen to all these different discussions, people will say, well, the Eagle Ford and the Bakken have peaked and they're in terminal decline now. Some people will say that, and they'll show evidence. But then I just saw an article recently that the Bakken was like holding production. So I think these are all kind of factors of, like Josh talked about earlier, this incremental or additive, just over time, the new technologies, new techniques, just being applied to these things. I mean, they're not a cornucopia that's inexhaustible, but so goes the Permian. A lot of people say there goes, the oil price. So, a lot of people have different views on this. I'm not a geologist, but if you get back on trend growth and you're, 1.5 million, 2 million barrels a day in demand growth going forward, I just think that the underinvestment has been, I don't think, if you remember back during the original shale boom, I guess you would call it that, when everybody was throwing money at it. I remember the ridiculous, I mean, it was during the first Trump administration. I read an article. I remember because it was in USA Today, which I call the McPaper. It's just like junk food news. And it's like, we're going to go to 25 million barrels a day. We're going to be the new Saudi. I mean, it's just so goofy. I mean, some of these things are just not going to happen. But what is going to happen? Because, if the Permian plateaus, okay, what's that mean? If it goes into decline, what's that mean? If they continue to be able to apply incremental technological advances and extract, because you read different things from different people. I follow a lot of this, but I'm not a geologist. I mean, I have friends at Schlumberger. I've talked to people about these things, and, parent wells, child wells, longer laterals, different fracking techniques. I mean, it's just a lot to understand. So I just try to focus on the big picture, that these 4.5 billion people are going to demand more hydrocarbons. And, I think if you get into synchronized growth, like Josh said, you're going to have a problem supplying enough oil. I guess that's my whole point. But I think there are areas around the world that haven't had sufficient capital applied to them. And if they did, I'm interested, like watching what YPF is doing now in Argentina in the Vaca Muerta, now that Milei is in power, and some of the things they're talking about doing. Okay, if they kind of, are able to, it's just from its interesting perspective, you can see of just how much politics and policy that you have in a country, how can it affect these things. And I think people need to be cognizant of that. It's not the only thing, but it's definitely has an effect. If you don't have an environment conducive to, people wanting to apply billions of dollars of capital to these problems, then it's just not going to happen. And these are extractive industries that require continuous investment.
Well, gentlemen, this has been a fantastic conversation. I learned a ton over the course of it. I'm sure the audience will as well. We'll have to do a part 3 later in the year. I'd love to talk more about the Permian Basin. I'd love to talk natural gas, as well as the most hated of hydrocarbons, coal. So let's save all that for next time. Before I do let you go, John, tell us about the Actionable Intelligence Alert and where people can find that.
Just go on YouTube or Substack, type it in search, you'll find it.
Great. Well, I'll put links to it in the description below, so people don't even have to do that. They can just click the links below. And Josh, talk to us about buys and interests, what it is you do there, and anywhere else you'd like to direct people online.
Yeah, sure. We invest in publicly traded oil and gas companies, run a small fund that we're not soliciting money for. And none of this has been investment advice or recommendations or anything of that sort. You can find us at bisoninterest.com. We have a monthly newsletter we send out for free for clients and prospective clients, as well as for those sort of broadly interested, and are somewhat active on social media as well.
Great. Well, I'll put links to the website and your social media in the description below as well. Once again, gentlemen, it's been a blast. Thanks so much for coming on.
Thank you.
Thanks a lot.